So hi girls, welcome back to your second part of Advanced Financial Management in your first chapter, that is Investment Decisions and Risk Analysis. So here we will be continuing from the next topic, that is known as types of risk. Under your types of risk you have 11 types of risk, that is financial, static, fundamental, pure, exchange rate, business risk, liquidity risk, country risk, market risk, credit risk, and operational risk. We will look into all of these risks in detail in the upcoming topics. So to begin with, let's start with the first type of risk, that is known as your financial risk. Now what is the financial risk? Okay, so basically financial risk is the risk borne. Okay, this is basically a risk which is borne by equity shareholders. Very important, this is a type of risk which is borne only by equity shareholders. Now who are equity shareholders? They are basically those shareholders, they are the owners of the company. They are also known as the owners of the company because they hold the maximum amount of shares in a particular company. Okay, they are very important in terms of company. So this kind of risk is borne by the equity shareholders. Why is it borne by equity shareholders? Is because of the firm's use of debt. Okay, whatever debt it is taking, whatever loans the firm is taking, suppose if it is not able to repay or if there is any loss, then the equity shareholders will be bearing this sort of risk which is occurred in a particular company. Now if the in financial risk is if the company is raising capital, you all know that the company will raise certain amount of capital, right? Because the company requires capital for its functioning and also for its day-to-day operation. So when the company is raising capital, they borrow money. They borrow money from the public, they borrow money from the shareholders, from their partners. So they continuously borrow money, right? So now this money that they've borrowed, they must pay back the money at some future date. Exactly, when they occur profits or anything, they need to pay back certain amount of money. Whatever amount of money they've raised, they need to pay back that amount to the people who've lent the amount to the company. Okay, so when you are lending the amount on a future date, you will have to pay. Suppose you've taken 50,000. Okay, suppose now you've taken 50,000 from one person, that is from one shareholder. You've taken 50,000. Now while returning, you will not only return this 50,000, plus you will give certain amount of interest. Okay, so you will give certain amount of interest, or whatever profit you have, based on that profit you will be giving that amount, that is plus the financing charges. Okay, now you all know that when you're paying back the amount of money at a future date, you will be paying along with the financial charges. This increases the degree of uncertainty. Now when you are doing this, it will increase the degree of uncertainty. Now let's see, why does it increase the degree of uncertainty? Because the company must have been in okay, this increases the degree of uncertainty about the company because it must have enough income to pay back the amount at some time in future. Very true. Okay, now suppose you have a particular company. Now you are the owner of a particular company. Okay, now you do not know whether the company might make profits or the company might make loss. Now suppose you are taking 50,000 and saying, okay fine, I will pay you with the interest amount at a later date. You do not know whether you will get profits or you will face loss, right? So there is lot of uncertainty. So you should be very careful in this type of risk that is borne by the equity shareholders. So now moving on to your next point, next type of risk, that is static and dynamic risk. Now what is static? Static means constant. Okay, static means constant. Now what is dynamic? Dynamic is continuous, fluctuating. Okay, fluctuation. Okay, static is something that remains constant, whereas dynamic is something that is continuously fluctuating. Now what is a dynamic risk? Okay, now let's look into what is a dynamic risk. Dynamic risk are basically the kind of risk that is resulting because of the changes in the economy. For example, in the earlier videos I told you all, there are certain factors that will be affecting, and because of which there will be risk that will be arising. It could be a social, political, technological, it could be any factor that is increase in GDP or increasing in the or decrease in the downfall of the economy, any factor that could result in the changes, any factor, dynamic risk will arise only because of the changes in the economy. Now changes in the economy are only because of the external factors. Here, because of the external factors, dynamic risk is arising. Changes, for example, changes in the price level, consumer taste, income, output, and technology. This may cause financial loss to the members of the economy. company. Okay, these dynamic risk normally benefit society over a long run. Okay, no doubt it is. So when you are into a particular business, you should not only see the benefit of your own company, you should benefit the society also at large. Now, how will you benefit the society at large? Suppose you are opening a particular company, you need to create employment opportunities. That is, you will obviously give certain positions to people in your firm, right? You will employ certain people at in your firm. So in this way, you are benefiting your society. Okay, you are benefiting your society at large. Now, when you do this, okay, you are benefiting the society at large since they are the result of adjustments and misallocation of resources. Although these dynamic risks may affect large number of individuals, they are generally considered less predictable. Now, what you need to know about dynamic risk is something that is occurring because of the external factors and because of the changes in the economy. They affect the individuals at large, whereas they benefit the society in the long term. Okay, and they are very less predictable. You cannot easily predict the dynamic risk. Okay, whereas static risk you can predict it, whereas dynamic risk you cannot predict it so easily. Okay, it is less predictable compared to static risk, since they do not occur with any precise degree of regularity. Suppose for example, it's been a year you've started a company. Okay, suppose it's been a year you've started a company and you do not see any kind of risk for at least 1 year or so. Then suddenly you face certain changes in the economy because of which you face a risk. Okay, then again after the risk is elevated, you might not face it for another 5 years. So there is no any precise degree or regularity. It is nothing which is regular. It could occur any time. Okay, and you cannot even predict it so easily. You do not even know when it is going to occur. So the degree of predicting is very less in dynamic risk. Okay, I hope it's very clear. Dynamic risk is something which has continuous fluctuating. Okay, it is not constant. Now next is static risk. Static risk is something, static means constant. Okay, the name itself suggests that static is something which is constant. So here it involves losses that would occur even if there are no changes in the economy. Okay, here you are incurring losses even if there are no changes in the economy. Suppose it is political, social, technological. Even if there are no changes here, there is a loss which is occurring because in terms of static risk. For example, it is consumer taste. Okay, suppose now for example lace. Okay, lace is coming up with a new flavor. Suppose it is not liked by the people because of their consumer taste and preferences, then again the demand goes less, and also they could face a certain amount of risk because of the consumer taste. Then output, income, level of technology constant. Okay, now, some individuals will suffer the financial loss, but when compared to dynamic, their individuals will suffer at a greater rate. But here only some individuals are facing a financial loss. These losses arise from causes other than the change in the economy. Okay, these are other than the change in the economy. It is not something related to social, political, nothing as such. It is something other when in the economy, such as perils of nature and dishonesty of other individuals. Unlike dynamic risk, static risk are not a source of gain to the society. Static risk involves either destruction of asset or change in the possession of dishonesty of human failure. Static losses tend to occur at a degree of regularity. So to make it very simple for you all to understand what static risk exactly is. For example, now you have a company and the company catches fire. Okay, so it is very uncertain, right? So there is no change in the economy, there is nothing as such, but suddenly there is an outbreak of fire. Or suppose, for example, someone would have been supplying certain goods to the other party, and the other party will agree to pay you suppose 50,000, and they do not pay. So you are occurring a risk. Okay, that is a loss. So change in the possession of a result, or it could be a dishonest behavior by an individual. This is because of this is in terms of static risk. Okay, so I hope static and dynamic and static risk is very clear to you all. This is the first one and this is the second one. Now next is fundamental risk and particular risk. What is fundamental risk? Fundamental risk, first one, it involves losses that are impersonal in origin. Okay, it is something that is impersonal. It is not something personal. It is impersonal in origin and consequence. Now they are a group of risk which is caused for the most part by economic, social and political phenomenon, although they may also result from physical occurrences. They affect large segments, okay, very important, they are affecting large segments or even all of the population, okay. Particular risk. Now what happens here is basically in the fundamental risk. Fundamental, now what is fundamental? Fundamental is you are talking about a particular group at a large thing, right? So it involves this fundamental kind of risk involves losses, okay. No doubt any risk will involve loss only, okay. It is involving losses, but they are nothing related to a particular person. They are very impersonal in origin and their consequences are also very impersonal. This is a group of risk, okay, wherein it is caused for most by part of economic. It is caused mainly by economic, social and political phenomenon. It is mainly caused because of the changes in the economy, society, that is social, because of the social behaviors or any acts which are brought into consideration, or political phenomena. Also this may result from physical occurrences also. It could be a natural flood, disasters, okay. It could be anything, it could be tsunami or anything. It can also occur from physical phenomenon also, but mostly it is from economic, social and political phenomenons. They affect the large segments or even of all the population. So next second one is your particular risk, okay. Now what is particular risk? Particular risk involve losses that arise out of individual events, okay. It is arising out of individual events, okay. Particular risk, particular, one particular person, the name itself suggests individual, okay. They are arising because of individual event and are felt by individuals. These are arising out of individual event and it is felt by only one individual rather than by entire group. Suppose for example, I as a human, I am working in a particular company, I am facing a particular risk which is arising out of an individual event, so it is affecting me only as an individual. It is not affecting the entire group. It is individual event. It is only felt by individual instead of an entire group. Now, this particular risk can be either static or dynamic. We studied static is something constant, dynamic is something continuously fluctuating. Okay, for examples, okay, these are the examples of why you can face the particular risk. It could be unemployment, it could be war, inflation, earthquakes, floods, and all these are fundamental risks, okay, when compared to the particular risk, okay. These are something you need to keep into consideration. Fundamental is impersonal origin, whereas particular risk is arising out of individual event and it is affected by individual rather than the entire group. For example, you have inflation, war, earthquakes, floods, and these are all the examples of fundamental risk. This was the comparison between fundamental and particular risk. Now, for example, this is basically an example which is given here. The burning of an house and robbery of a bank are particular risk, okay. See, this is particular risk. Now I'll tell you why particular risk. I think by now you've understood the concept of particular risk. Suppose for example you have a house, okay, it belongs to you as an individual. So if it catches fire, it is affecting you only. You are the alone person who's facing the loss. And if the robbery takes place, you are in the particular house, you are the alone individual who is facing that particular risk. That is why it is particular risk, okay. So now let's move on to the next type of risk, okay. The particular risk is being continued. So let's look into the other meaning of the particular risk. Now, particular risks are also considered to be individuals' own responsibility. Inappropriate subjects for actions by society as whole. They are dealt with the individual through the use of insurance, loss prevention, or some. For example, now your house, you have a particular house, okay, and it catches fire. Suppose you have done insurance, okay, you have this LIC and all of that. Suppose you've done insurance. Suppose if your house catches fire also, you will be able to get certain amount of money from the insurance company. This is a particular risk, okay. So now let's move on to the next type of risk, that is speculative risk and pure risk. Now what is speculative? The name itself suggests speculative is something you are very speculative of, negotiating of. Okay, speculative risk. Now speculative risk is describes a situation where there is possibility of loss. Okay, here it is a type of risk where there is possibility of loss but also a possibility of gain. This is a type of risk. See, higher the risk, higher will be the return. Lower the risk, lower will be the return. Okay, you need to understand this. High risk, high return. Low risk, low return. When you are in a particular investment company, you need to take the highest amount of risk. Only if you take higher risks in life as an investment decision, you will be able to incur higher profits and higher return. If you are only like no, it involves high risk, so I will take less risk, then you will only generate less return. Okay, everything involves risk, so you should be bold enough to take higher risks in order to generate higher return. Now, in speculative risk, it is a kind of risk which involves certain amount of risk. But here there is a situation wherein you can gain either higher profits and either a higher loss. There is possibility of loss, there is possibility of gain. Okay, for example, gambling is a good example of speculative risk. Okay, speculative risk example, very important, gambling. In a gambling situation, risk is deliberately created in hope of gain. Now what is gambling? Gambling is something which is illegal, right? So in terms of that, there are chances of high risk. Okay, you are creating a situation of risk in order to get gains. Okay, the student wagering rupees 10 on the outcome of Saturday's game faces possibility of loss, but this is accompanied by possibility of gain. The entrepreneur or capitalist faces speculative risk in the quest for the profit. The investment made may be lost in product is not accepted by the market at a price sufficient to over cost, but risk is borne in return of possibility of profit. So here, if you are getting certain amount of risk, if you're facing certain amount of risk, there is possibility of profit also. Okay, and gambling is the one good example of speculative risk, wherein you are creating a situation of risk in order to get gains with the with an hope of getting gains. Next is pure risk. Okay, what is pure risk? Pure risk is basically in comparison to static speculative risk. In contrast, it is used to designate those situations that involve only chance of loss or no loss. Okay, basically here it is designing a situation where there is either loss or there is no loss. Okay, the best example for pure risk is possibility of loss surrounding of ownership of property. The person who buys an automobile, for example, immediately faces the possibility that something may happen to damage or destroy the automobile, the possibility of income or no loss. Suppose, for example, we as people will buy a bike. Now when you are buying a bike, you will have a lot of factors that will be coming into consideration. You could meet with an accident, or you could or the bike could be robbed. Okay, so here there is possibility of outcome. Okay, whether you can either buy it and face a loss, or you can either avoid it and face no loss only. Now the distinction between pure and speculative risk is an important one, because normally only pure risks are insurable. Okay, because when you are buying a bike also, you can insure it, you can create a LIC policy, or you can do anything and you can insure it. Insurance is not concerned with protection of individuals against those losses arising out of speculative, but whereas in terms of speculative risk, you cannot carry out insurance, or you cannot do anything as such, whereas you can do it in terms of personal in terms of pure risk. Okay, speculative risk is voluntary accepted because of its two-dimensional nature, which includes the possibility of gain. Speculative risk, as I told you all, there is high possibility of loss and there is high possibility of gain also, whereas in pure risk, there is either loss or there is no loss at all. Now next, let's move on to the types of pure risk. Under this pure risk, you have two types of pure risk, that is personal and property. Personal, again, what does it say? Personal, okay, you have four types of pure risks. Very important. First one is personal risk. What is personal risk? Personal risk, these consists of possibility of loss of income asset as a result of loss of the ability to earn income. In general, earning power is subject to 4 perils. Okay, now 4 perils are there, 4 things that you need to consider. That is premature death, dependent old age, sickness or disability, or unemployment. These are the types of personal risk that you will be facing. That is premature death. Okay, death before the time, dependent old age, suppose you are into an old age and you're depending on someone else, sickness or disability, and unemployment. These are the type of personal risk. Personal risk as individual. What are the risks that we go through as its individual person? Okay, we could either lose our house, lose our property, or meet with an accident, or it could be premature death, dependent old age, sickness, disability, unemployment. These are personal risk. Now, what is property risk? Property risk, I think the name itself suggests that it is something related to property, right? So now anyone who owns a property faces property risk. For example, now these days everyone owns a property and they will face something known as property risk. Now, what in terms of property risk? It could be higher income tax, it could be someone trespassing your property. Okay, someone trying to file a case against the property saying it's their property. So this is also a type of risk, simple because such possessions can be destroyed or stolen, or someone could either destroy your property by probably it could catch fire, or they could intentionally destroy your property. So property risk embrace 2 distinct types of loss. Okay, in property there are 2 types of losses, that is direct loss and indirect or consequential loss. Under your property risk you have 2 types of losses. Okay, that is direct or indirect. Now, what is direct? Direct is the simplest to understand. If a house is destroyed by fire, okay, suppose you have a property, your house is destroyed by fire, owner loses, the value of the house is lost. Then direct loss, it is something which is direct. Whereas in, okay, so here in direct loss, however, in addition to losing the value of the house, this is direct loss. Okay, this is very much direct, it is a direct loss. Whereas, however, what happens here is basically in terms of property risk, how you can write the particular thing is basically, here you can say the property risk is again classified into 2 types, that is 2 types of loss, that is direct or indirect, and it is basically faced by a particular person who owns a particular property. Okay, it could be either destroyed or it could be stolen, for example. Now, however, in addition, when a house catches fire, it loses the property loses its value. The building itself will lose its value because no one will obviously want to purchase a particular thing, right? So an even better example is the case of business or firm. Okay, but whereas indirect loss is something which is suppose you have a particular property and someone is filing a case against it, so that is something you are indirectly facing a loss. You're not directly facing a loss, whereas you are indirectly facing a loss in terms of that is consequential. Okay, here it also says that property risk then can involve 2 types of losses, that is loss of property or loss of the use of property. See, as I told you all, if someone is legally claiming your property, okay, on illegal terms, obviously the court will bring a stay order and they will say unless the decision is not made, even you will not be able to stay in this particular property. So that is resulting in indirect loss. Whereas direct loss is something you are living in that particular property and the house catches fire, or it could be a robbery or anything. That is direct. This is indirect. Okay, now next type of risk is liability risk under your pure risk. Okay, liability, what is liability? Liability is unintentional injury. Okay, the basic peril. Okay, this is something which is important. It is the peril in the liability risk is the unintentional injury of other persons or damage to their property due to negligence or carelessness. This type of risk arises because of negligence or carelessness. However, liability may also result from intentional injuries or damage. Under our legal system, the laws, okay, here what is happening is basically liability risk is suppose in a particular business, when you are carrying out a particular business, you will have certain amount of competitors. Okay, now these competitors might want to harm your particular business because they do not want your market share to grow. Or they could be certain employees in your own company who would be against you. So this could be basically in such a situation that either outsiders can come and harm your harm your particular property or harm your particular assets in the organization, or burn down your company, or it could be your insiders who could either intentionally carry out any negligence or unintentionally do a negligence or carelessness. Because of this particular damages occur in the terms of liability risk. Okay, and under the liability risk, it involves possibility of loss, that is of present assets, as I told you all, or future income as a result of damages. Okay, suppose for example you have a company, you have a sawmill, okay, and now for that particular sawmill, in order to cut trees, you have various machineries. Now by mistake also, if you haven't switched off the switch of the machinery, and it's been continuously burning throughout the night, it might catch fire. Okay, it might catch fire because of the short circuit. So here there is a chance of the entire company burning down, and which will result to future losses. Okay, unintentional damage will happen, and it will lead to, and when the machinery burns down, you will not be able to carry out the work, so it will result in losses until the new machinery does not arise. It will burn down. Here you will face losses. So this is what it is saying. It could be intentional or it could be unintentional loss. Now next is risk arising from the failure of others. Now what is this risk arising out of the failures of others? Now when there is a particular person, and when the other person agrees to perform a service for you, or he or she undertakes an obligation that you hope will be met, when the person's failure to meet the obligation would result in your financial loss, risk exists. Example of risk in this category would include failure of a contractor to complete the construction project as scheduled, or failure of debtors to make payment as expected. With the development of the internet and rapid evolution, e-commerce and variety of new risks, the most easiest example I can give you all for this is basically online shopping. Okay, online shopping. Now risk arising from the failure of others. Now online shopping example, you take Flipkart. Okay, now you take for example, it's Flipkart. Now you're ordering for a certain product. Okay, now you read the reviews, you read the comments, you read everything. Now Flipkart is the one who's giving you service. He is making the product available to you. Now you look at that particular product and you order it online. Okay, now you receive that particular product, but the particular product is damaged, so it is a risk arising from the failure of others. Now here Flipkart has not been able to keep his promise of delivering good product to you, and hence it resulted in a risk. Now the chances are you've already made a payment. Now the chances are you could either get a refund or you will not get a refund, so you are facing a certain amount of risk. Or the best example could be a construction project as scheduled. Now a particular construction project, suppose a particular contractor has taken saying that he will complete a particular project in suppose 6 months. Okay, but he is not able to do so. Now you as a person who is investing will face a greater amount of risk, because you will have to keep investing again and again for the material, that is cement, that is various other raw materials that are included in the construction work. So it is the failure, as he is failing to make a particular project ready within a particular scheduled period of time. Okay, this is risk arising from the failure of others. Now next is exchange rate risk. What is exchange rate risk? Is basically, it is particularly important for investors. The term exchange itself says that it is for the investors. Okay, now investors who have large amount of overseas investment. Okay, now you also know we make overseas investment, right, and wish to sell and convert their profit to their home currency. Okay, now if exchange rate risk is high, even though substantial profits may have to be been made overseas, the value of the home currency may be less than the overseas currency and maybe erode a significant amount of investment earnings. That is more volatile an exchange rate between home investment currency, the greater the risk of differing currency value. Now in exchange rate risk, exchange is usually related to currency. Okay, now you all know, suppose if you want to move into a different country, or if you want to go for a tour also to another country, you need to exchange your currency. Suppose it is your Indian currency, suppose you're going to the US, then you have to convert your Indian currency into the US dollar, right? So when you're converting, the Indian rupee value is very less when compared to the US. Suppose you want to take $60, you need to pay somewhere around now the currency value is increased, you need to pay a higher amount to get that 60 rupees or the $60, right? So there is high rate of fluctuation. Okay, there is a difference in the change. Suppose if a particular investor wants to invest in petrol in Saudi, so he needs to pay a higher amount because the Indian rupee value when compared to the Saudi dirham is very less. So there is continuous fluctuation in the home currency. So you might invest higher amount and get lesser return when you're comparing when you're converting that particular amount. Suppose for example, if you're converting a dollar into rupees, maybe you might get a higher return, right? So there is a difference in the currency. When you're investing, you need to very much take into consideration the country where you're investing and what is the value of the currency, how much is the value for that particular currency, okay, and how much will it change while you're converting that particular currency. All of this needs to be taken into consideration while you are carrying out your investment decisions, okay, because there is currency risk which is involved to the particular. This risk is only faced by the investors. It is not faced by the normal people. It is faced by the investors and also by the people who are planning to move or shift in that particular country, or who are planning to go for a vacation in that particular country. It depends on the currency value. Now, next type of risk is your business risk. Okay, now what is the business risk? The term itself states that something related to business, right? Now the term business risk refers to the possibility of inadequate profits or even losses because of the uncertainties. As we all know, it is business is something which is completely based on uncertain activities, right? So it is you could, in business, you could either face profits or you could either face losses. Example, now what is happening again, if you look into now when you're talking about business, you also know in business there is a lot of competition. For example, you can say increased competition, or it could be changes in the preferences of the consumer, or it could be strike. Now why is there a strike? Is basically in a business, if you have employees who are working for you and if you're not paying them properly, if you're not taking care of the employees, they could go on a strike. That is, you will have in a particular factory or an industry, you will have something known as trade union. Now when these employees go on strike, your work will stop, and when your work stops, you will incur certain amount of loss. Or it could be also because of the change in government policy or obsolescence. Okay, the uncertainty of income is caused at the nature of the company's business, measured by ratio of its operating earnings. This means that the less certain you are about income flows of firm, less certain the income will flow back to an investors. All you need to know about a business risk is basically every business will have certain amount of risk, and you could either incur high losses or incur high profits. Okay, now why is business facing a certain amount of risk? Is because of the taste and preferences, the changes of the taste and preferences. Either could be strikes, either it could be increase in competition, and it could be changes in the government policy, or it could be obsolescence, that is continuously changes in the technology. Now technology now when they're asking about technological changes, now business usually faces a huge technological risk. Okay, I'll tell you why. Because technology is something that keeps updating every now and then, and if you want to keep yourself updated with the changing technology, you need to invest more. So this is a kind of risk. The company might suppose if the company is not updating with the changes in the technology, it will be staying behind and it will not be able to carry out the operations very effectively. Okay, now for example, here if you see an example of business risk could include a rubbish company that typically would experience stable income and growth over time, would have low business risk compared to a steel company, whereas sales earning fluctuate according to the needs of steel product. Any business for that matter will incur certain amount of risk. Okay, this is something you need to understand. It could be any company, it could be a steel company, it could be a rubbish company, or anything as such. Next one is your liquidity. What is liquid? Something which is liquid state. Now what is liquidity? Is basically it is introduced by the secondary market. I think you all know what a primary market, secondary market, and a tertiary market is, right? So liquidity risk is a risk that is introduced by the secondary market for the company to meet its future short-term financial obligations. Okay, this kind of risk is introduced by the secondary market. Okay, secondary market, why is it introduced? To meet its future short-term financial obligations. Okay, whatever the short-term obligations, short-term is basically for a period of 2 months to 2, 3 or 6 months, whereas long-term is 6, 12 or a period of 1 year or 1.5 years or more. Okay, now when an investor purchases a security, they expect that at some future period they will be able to sell the security at a profit and redeem its value as cash for consumption. This is liquidity. Best example for liquidity is gold. Okay, best example is gold. For you to understand, as investors we go and purchase gold, right? Now why are we purchasing gold? As a means of security, and some gold is very liquid in nature. Now why are we purchasing gold as a means of security? Because someday, even if we are facing a loss, it could be, suppose we are having a business, or it could be any personal issues, we can easily go sell that gold. Depending on what the price of gold is, the price when you're selling it, the price of gold could either be high or it could be either low. Now when the price of gold is very high, you will incur high amount of profits, okay? But whereas the price is low, you will not be able to get that amount as you invested earlier. So gold is highly liquid in nature. Suppose you're purchasing gold with an intention of selling it in the future for a higher rate, then you are gaining higher amount of profits. So there is liquidity risk. Now why when will you face a risk in gold? When you are purchasing for a higher price, but whereas in the future, if the price of the gold decreases, that means your investment is a risk based on the future date. Okay, or you could give an example of gold, or similarly you could give an example of the security or shares. Okay, now next type of risk is your country risk. Now what is country risk? Country risk is basically, see, for example, I am in India and I am planning to start a particular company in Dubai. Okay, now before starting a particular company in Dubai, I need to study how the environment of Dubai is, what is the value of the currency, how is the rules and regulations of Dubai, and how is it very, how are the employees there, will people how will I be able to grow my market share there, will I be able to invest in a more strategical manner? All of this I need to study before I am entering into that particular company and entering or investing in that particular company. This is also a termed as political risk. Very important. Okay, political risk. Now why is country and political risk coinciding with each other is basically, we all know that politics is very important. You need to know which is the party that is ruling in a particular state and what are their rules and regulations, how have they set the law and order of the particular country. Okay, so country risk is directly related to your political risk, because it is the risk of investing funds in another country whereby a major change in political see, suppose I cannot take the example of India. Suppose now India has a country risk. Okay, suppose a person who's coming from abroad might face a country risk. Okay, now why is he facing a country risk? Okay, suppose until date the Congress party was ruling and now it is the BJP party that is ruling. Now when they're ruling, the BJP party will have the separate rules and regulations, they will have the separate economic environment. Now this economic environment to the investor can either be proved as very profitable, or it could be very, or it could prove him lot of losses. Okay, so I hope it's clear to you now as how the political risk is influencing. Okay, this could devaluate the investment and reduce the overall return. This type of risk is usually restricted to emerging or developing countries that do not have a stable or economical and political areas. Okay, now India is always, even if it is slightly developed, it is always known as a developing country, right? So it is very important when you're investing in a particular country, you need to see whether it is a developed, underdeveloped, developing, or underdeveloped country. Okay, these are also the factors that you need to consider while you are investing in a particular country. This is known as country risk. Next one is market risk. Market risk is because, as we all know, there is a lot of competition and growing the market share is not as easy as it is, because there are continuous price fluctuations or volatility increases. Okay, because market risk is directly related to the changes or fluctuations in the prices. Okay, here volatility increases and decreases in the daily market. Now today the price might be very high and tomorrow the price might be very low. Okay, this type of risk mainly implies to both stocks and options and tends to perform well in bull Okay, you will be studying about when you're talking about market, you need to know that there are types of market, that is bull, bear, stag. Okay, so in okay, so I'm not really sure if you've studied about the bull, bear and stag market, but here you will see in terms of market risk, this type of risk mainly applies to both stocks and options. Okay, there is something known as stocks, options, securities. Okay, there's securities, shares, all of these are a part of a market, and these stocks and options. Okay, these stocks and options perform very well in the bull market. Bull market goes upwards. Okay, it goes upwards, that is decreasing to increasing, whereas bear market moves downwards. Okay, see, so these stocks and options perform well in the increasing market, whereas it performs very bad in the bear market, that is decreasing market. Generally with stock market risk, the more volatility within the market, the more probability that there is the investment will increase and decrease. While you're investing in while you're taking into consideration a market risk, you also need to take into consideration what is the amount of competition, what kind of market is it, whether it is a bull market, whether it is a bear market, whether it is a stag market, what kind of market are you investing, and how is the nature of investment. Okay, and when you're investing, your stock options are nothing but the securities only. Okay, it could be okay, it is your future options, it is your forward options. Okay, I'm not really sure if you've studied about it, but you have various options like a future, forward contracts. Okay, so you have various options also, that is call option, put option. Call option is you are selling, call option is you are buying, whereas put option is you are selling. When you're dealing in an options market is call option, you are buying it, whereas in a put option you are selling it. How is it while you're buying securities, how is it while you're selling securities? These are the two things you need to see in the options market. Okay, while you're investing in the market risk. Next one is your credit risk. Credit risk is the risk of loss due to debtors non-payment of loan. Okay, this is the kind of risk that everyone faces, because there will be a certain amount that you will be giving it to another party, and wherein you will be supplying goods to another party, wherein they will promise that they will make the payment in a certain period of time. But in case if they do not make the payment for the particular goods that they've purchased, then it is your company that will be facing the amount of loss. It will be a kind of loan that they have not paid. Okay, and also you will have to face the interest. Okay, you will there will be certain amount of risk that will be involved, and also principal or interest risk that you will be facing in terms of credit risk. Next is operational risk. Operation, as you all know, that business activities are carried out on a day-to-day operation basis. Okay, so it is a now every industry or every firm will have day-to-day operations. So operation is defined, risk is defined as the risk of resulting in inadequate or failed internal process. Now your operational risk is something which is internal. Okay, internal. Suppose if your staff goes on strike. Okay, suppose if your staff is going on strike, or lack of funds, or if your company does not have enough funds, you will not be able to carry out day-to-day operation, which will result in the operational risk. This type of risk is arising because of the internal consequences. Okay, it is something which is internal. So now let's move on to your next topic, that is known as risk and return. Now when you're talking about risk is something which is uncertain, and return is something you are getting in return. Okay, in return of a particular investment, of a particular security. And risk and return are interrelated with each other. Risk and return are related. Okay, they cannot be separated. Okay, risk and return are always together. Now when you're looking into the risk and return, risk is basically here the portion of variability of return. Okay, whatever the portion of variability of return of a security. Suppose for example you're investing in a particular security. Now when you're investing in a certain security, you are always getting a return. Okay, so the portion of variability of return of a security that is caused by external factors is systematic risk. What is a systematic risk? Systematic risk is basically a risk, okay, wherein suppose you are carrying out an investment, but that particular investment's return is related to is basically it is affected or it is caused by external factors. Okay, external factors like social, political, technological. If it is caused by external factors, if the return is affected by the external factors, it is called as systematic risk. And this systematic risk is also known as market risk. Okay, systematic risk also known as market risk or non-diversifiable risk. And as I have been already repeating, these kind of risk, when risk is caused because of external factors, it is usually because of economical, political instability, economic recession, macro policy of the government, changes in the policy of the government. Simple to understand. Okay, all of these particular external factors will affect the price. Okay, suppose you have invested, okay, and you've bought shares of rupees 50. Okay, 50 rupees shares you've bought. Okay, now when you've bought 50 rupees shares, suddenly there is a change in government, there is a change in government policies. Okay, there are political factors, economic factors, the price value has gone down, and suppose your 50 rupees share reduces to 20 rupees. Okay, 50 rupees share reduces to 20 rupees. All these factors are affecting the price of the share. Okay, the effect of the share systematically, thus the variation of return in share, which is caused by, now when okay, let me make it very simple for you all. Risk and return are something that is directly related with each other. And the risk, and suppose for example you are purchasing gold, as I told you all now, or for example you're purchasing a security. You're purchasing a security of 50 rupees with an intention that you will sell this 50 rupees security for a higher price in future, and you will get somewhere around 100 rupees, and you will make profits. But suddenly there is a change in the suddenly there is a change in the external factors. There is change in the government, there is a change in the policy of the government, the price value goes down. All of these factors will affect your share. Okay, suppose you've bought a share of 50 rupees, it will directly affect the share market. Now what happens if it affects the share market? Now this 50 rupees share will lose its value. This 50 rupees share will fall down to 20 rupees or 25 rupees. Now even if you are selling it, you are facing a loss. Okay, you are losing 25 rupees, whereas you invested 50 rupees. You're only getting back 25 rupees. The rest 25 rupees is a loss for you all. So when these securities, while you're investing, are affected by various factors, and the price of this also is affected. This is why it is known as systematic risk. Okay, the variation of return in shares which is caused by these factors is known as systematic risk. Okay, these are the factors that are affecting your investment. It is and also the return that you are getting. It is known as systematic risk. Now, the return from the security sometimes varies of certain factors affecting only company issuing with security. Example are raw material scarcity, labor strike. Okay, as I told you all, these are all the factors that you need to take into consideration. It could be your internal factors. Your internal factors are your employees, your raw material, your day-to-day working cost. Okay, you have various other factors, whereas in external you have your social, you have political, all of these factors that will directly or indirectly affect your working of the company. Okay, now, or which will directly or indirectly relate to your risk and will affect your return. Now, when variability of return occurs because of such firm specific factors known as unsystematic risk. Now, what is unsystematic risk? Systematic risk, as we all studied earlier, it is something that is changes in the economy, right? Here, what is unsystematic? Raw material, scarcity, labor, these are internal factors. Okay, these are internal. What is firm specific? These are specific to a particular firm. It is internal. Okay, these are internal factors that are affecting the return of a particular company. This is known as unsystematic risk. Okay, this particular risk is controllable if you take proper control of your employees, if you take proper control of your day-to-day working of the operations. Okay, if you're making sure all your debt are repaid effectively, then this risk can be avoided. Okay, you can take complete control of an unsystematic risk because this is something which is internal, and you can take necessary decisions and you can control this particular risk. Whereas systematic risk is external, and external factors cannot be controlled. It is something which is uncertain. But whereas unsystematic risk, the factors are internal, it can be controlled. Now, the risk and return, as I told you all, trade-off. Risk and return are related to each other. They are interrelated. They cannot be separated. Now, they could be easily called the ability to sleep at night test. Okay. Now, what is this ability to sleep at night test? Here, you are deciding about the amount of risk one can take while remaining comfortable with their investments are very important. In investing world, the dictionary definition of risk is the chance that investment's actual return will be different than expected. Why is this return okay, I'll tell you all. Why is this return very different while you're investing? Suppose today you're investing 10 rupees and you might think that okay, fine, tomorrow I'll be getting 50 rupees, but not necessary that you get 50 rupees, right? Why is this? Because of the uncertainty of the factors, because of the situation. For example, COVID. No one knew the COVID situation would arise, right? Now, because of this particular COVID, how many of our investments have gone and lost? How many of the people have lost their jobs? So this is something which is uncertain. We didn't know something like coronavirus coming into existence, something like COVID-19 situation is coming into existence. This is something we never expected. Okay, I hope it's clear. Now, risk means you have the possibility of losing some or even the original investment. Now, as investors, while you're investing, you will have options. Okay, you need to carefully study your internal factors, you need to carefully study your external factors. You need to calculate what is your internal rate of return, how much is the payback period, in what amount of time will you be getting back your investment, then what will be the return, what is the net present value. Okay, what is the net present value, what is the rate of interest, all of this you will be taking into consideration while you are investing. Suppose now, for example, you have 4 projects. Okay, now project A, the investment is 40 rupees, project B it is 10 rupees, project C it could be 30 rupees, and project D it is suppose 100 rupees. Now, while you're investing, you need to be very smart enough. You suppose you have 1000 rupees for investment. Okay, you should not invest all this 1000 rupees in project A, neither you should do it in project B. You should carefully distribute your amount. Okay, you should you suppose you're investing in 1000 rupees, you're investing suppose 500 rupees in A, okay, 100 rupees in B, 100 rupees in C, 100 rupees in D. So what are you doing? You are diversifying your portfolio. You're not pulling in all eggs into one basket. You're not putting in all investment into one project. So even if project A is giving you loss, the B, C and D will give you profits. Okay, so not necessary that you need to invest all the amount into one project itself. You need to diversify your investment in order to face greater profits and to take advantage of the investment, okay, of all the projects. Now, as I told you all, when you're taking into consideration risk and return trade-off, what is risk and return trade-off? As investors, higher risk will give you higher return. Okay, low risk will give you low return. Okay, you need to always understand this. High risk, high return. Low risk, low return. This is your x-axis and this is your y-axis. This axis is your return axis. This is your standard deviation or your risk. This is the amount of risk you will take. So the arrow moves in the upward direction, which says low risk, you're getting low return. You will stay right here. Okay, low risk is your low return, high risk is the high return. You need to have the potential to take up a higher risk and get the higher return. Okay, now low levels of uncertainty, low risk are associated with low potential results. Now, when you're taking low risk, okay, you're saying no, I will only invest rupees 10. It's okay, I will get low return only. In that way, you will not be able to generate a higher market share. You will not be able to get a higher market share. You will stay in the bottom line itself. You will not be able to get a high return. Whereas if you are taking high risk, okay, you will have high return which will be associated to it. So this is known as risk and return trade-off, which is demonstrated graphically here. High risk, low risk, low return, high risk, high return. Okay, now for example, it says a common misconception is that high risk involves greater return. The risk or return trade-off tells us that higher risk will give you possibility higher return. There are no guarantees of return. See, Now this is something which you need to take into consideration. By now you will understand why is this coming into existence. It is because of the uncertainty. Okay, no risk is guaranteed. Even if you're telling high risk high return, the return is not guaranteed. Low risk low return is not guaranteed because of the unforeseen factors. That could be social, political, it could be your external factors, it could be your internal factors also. Okay, but risk means higher potential returns or higher potential losses. Okay, risk is directly related to return. Risk could either give you high, your return could either be high or you could be very low and you would face losses. Now on the lower end of the scale, the risk-free rate of return is represented. Risk-free rate of return is represented by the return on government securities, because there is chance of default is next to nothing. Now in case if you're investing in a government securities, okay, it could be your trade bills, it could be your treasury bills. Okay, if you're investing in your government securities, the chance of default is next to nothing. It is a kind of a safe security that you're investing in. It will not be much affected by the factors, but still there is amount of risk which is involved in those particular scale securities as well. Now determining what risk level is most appropriate for one is a difficult decision. No one will be able to tell you. Even if you are forecasting, okay, suppose even if you are investing and you are checking out all the details, if you are finding out how much return you will be getting, what is the amount of risk that you will be facing, that thing is certain. Okay, it is a very difficult situation. No one can come to an exact conclusion saying this is the amount of return that I'll get, or this is the amount of risk that I'll be facing. Okay, risk tolerance differs from person to person. The decision depends on investor goals, income, personal situation and factors. Suppose now, for example, you are opening a particular business and your friend is also opening a particular business. Now your friend or your financial position might be higher when compared to your friend. Okay, suppose you'll be able to invest rupees 50, whereas your friend will only be able to invest rupees 10, and your risk taking capability will also be greater when compared to your friend. So risk tolerance, your ability to tolerate risk will differ from person to person. This decision is completely on the investor goals. Okay, what is the goal? Suppose you are investing rupees 50 with an intention of getting higher profits and expanding your market. You're also able to take higher risk. Okay, you have your different goals, whereas your friend might have different goals. He only might be investing with an intention that he wants to sell his goods and he wants to earn profits. Okay, that's all will be his investment will be his intention. He might not want to grow his market share, whereas your goals and his goals differ. Okay, investor goals differ, your income differs. As I told you, your income might be 50 rupees, his income might be 10 rupees. Your personal situation also might differ. You might do one person is completely doing business because he wants to do particular business. Some person might be doing it because he has no other option than to do a particular business and start something. So your factors differ, your situation differs. Okay, now next is risk and uncertainty. Now what is risk and uncertainty? Risk is something which is completely uncertain. Your return is also very much uncertain. Now risk refers to the set of unique outcomes for a given event which can be assigned probabilities. Now probabilities, what is probability? Probability could be form of 0.8, 0.1, 0.2. Now this particular probability is calculated. Okay, you will be looking into the future problems while we'll be calculating risk and probabilities. You will be able to clearly understand what I'm talking. See, this is known as probability. Okay, the NPV will be given to you and your probability 5,000. Okay, let me just show it to you all. Okay, now how will you be calculating your probability? This is the NPV of the project. You'll be investing so much, you will be calculating with the probability in order to check your return. Okay, 5,000 into 0.2 for example. That is known as probability. Okay, now risk refers to a set of unique outcomes. Your unique outcomes. Why is it unique outcomes? Suppose in the first project A, okay, Now you have three projects that will be taken into now you have two projects, okay? Your this is just an example. You have three projects. Project A, you're investing rupees 5,000. Project B, you're investing rupees 7,500, and project C, you're investing rupees 10,000. Probability is different. While you're calculating 5,000 into 0.2, the answer is different. 7,500 into 0.7, it's different. So you will be able to get an exact value of what will be the return to that particular project, okay? This is known as calculating of probability in order to check what is the amount of return that you will be getting from each and every project. So you are getting unique outcomes. The outcome from the project is differing for everyone. Now, risk exists when the decision maker is in a position to assign probabilities to various outcomes. Now, when you're making decisions, you will be able to assign probabilities. It could be 0.8, 0.1, 0.2, whatever based on your calculation. What is the probability that you are giving? Okay, based on how much ever you've studied, how much ever you've carried out your forecasting and everything. Based on this, you will be able to generate a probability and in order to check your outcome. Okay. Risk exists when the decision maker is in a position. Risk will only exist when the decision maker is in a position to assign probabilities to various outcomes. That is, probability distribution is known. Okay, your probability distribution is known. You will know what is the amount of risk that you will be facing and what will be amount of return you will be getting. This happens when he has some historical data. Very important. Suppose if you're investing in a particular company, okay, you need to check their historical data, whether the company has been facing high amount of profits, what is the market share, okay, what is their market share, what is the reputation of the company. All of this will be taken into consideration, and their balance sheet, okay, their balance sheet, their goodwill, all of this will be taken into consideration before you invest in a particular company. Your historical data will be taken into consideration. Based on that probability is assigned to the other projects of the same nature, and if the company is offering you a particular project, based on their historical data, you will assign certain probabilities in order to check what will be the return and how much is the risk involved in that particular project. Now, talking about uncertainty, this was about risk. Okay, now talking about uncertainty refers to the outcomes of a given event which are too unsure to be assigned probabilities. Uncertainty, we all know, it is something which is uncertain. We do not know what is going to happen, so you are not sure about anything. It is very much unsure. Okay, you are too unsure. You're not even sure about 1%, and it is very difficult to assign probabilities. Okay, so uncertainty refers to the outcome. Okay, you are generating an outcome, but then to generate that particular outcome, you are not very sure of what is the probability that you need to assign. Okay, suppose you have 5,000 as your investment. Now 0.8, you're not sure of whether you need to assign this as a probability or not. You are not sure about anything. Okay, it is uncertainty exists when decision maker has no historical data. When will you be assigning this kind of value? When you do not have any historical data from which to develop a probability distribution. Now you need to generate a probability distribution to see what will be the return. Okay, but you do not have any historical data, so you will not be sure about anything. Okay, but in this case, you need to make intelligent guess. You need to be very smart enough. You need to make intelligent guess in order to develop a subjective probability distribution. We cannot say that this is the exact probability that you can do, but you need to be smart enough to come closer to the amount of return. You need to be smart enough in order to generate a particular probability in terms of uncertain event wherein the historical data is missing. You need to be very calculative by checking what is the market share. Suppose historical data is missing, you need to check for different informations in order to come up with a probability distribution.